Joining us today, Mark Giambrone is Senior Managing Director and Equity Portfolio Manager at Barrow, Hanley. Mark, it's good to have you. Was there anything we learned today or something that we suspected was true about the overall market that got either confirmed or not confirmed?
Well, I think there's an old mantra in the market called "Don't fight the Fed," and it's true when the Fed is accommodative to the market, as it's been really for the vast majority of the last 12 years, and it's true now when it's removing that accommodation. So, you know, the market is going to struggle as we move forward here, as it's learning sort of to deal with a less friendly Fed. Fed.
It didn't seem like today the peak inflation argument did much for the bulls.
Well, it's because a peak is different than a sustainably too high a level. And that's really what we're talking about now. Is it may be peaking, and there's a lot of reasons to believe that's true, but it's still at a very high level that's destructive overall to the economy and to the consumer and to demand. And so it still needs to come down quite a bit for us to be in a comfortable range for inflation moving forward, you know, whether it's peaking at the moment or not.
All right. You do have some ideas. VICI is one, gaming entertainment REIT. A lot of the attributes that are au courant right now, predictable cash flow. Although I wonder if gaming and entertainment, for example, Party City's results, if the consumer is still a vulnerability here.
Well, I think what we found is, especially for the gaming REITs like Vici, they went through their most difficult environment maybe they'll ever face during an actual shutdown during the COVID period, and yet their customers or their tenants never missed a rent payment. And at this moment, if you look at MGM or some of the casino names that they are the landlord for, their balance sheets are in great shape, their cash flows are very strong. Vegas particularly is booming relative to even 2019. And so while, sure, there could be a slowdown, I think at the end of the day, the margin of safety here is dramatic. Their rent has inflation kickers in it. And so even if we see inflation, that won't have an impact for them specifically. They've got lots of cash flow, good balance sheets, and they pay nice high yields with, you know, stable and recurring revenues. It's something we like a lot.
That's interesting. You know, a lot of the financial earnings are going back a couple of weeks now. It's hard to remember, but you do like M&T, which has traded pretty well during the course of the year. What's our thought right now about regional banks and financials in general?
Sure. Well, so let me start with M&T Bank for a second, because there's lots of ways to win specifically with M&T Bank. It's true that in general, for the lenders, as rates rise, right, that's a positive for them as the interest margins expand, and generally, therefore, they're making more money as long as you're conscientious of where credit's going to be. I think that's where the market is concerned now, right, as to where will credit be, and then that could be more destructive to earnings than interest margins helping. What we like about M&T Bank specifically is there's lots of ways to win. So M&T Bank is a very high quality underwriter. They're purchasing and just went through an acquisition of People's Bancorp, another very high quality underwriter. So you're seeing a company that's clearly going to expand in interest margins, but also has a history of excellent underwriting. You have merger synergies, and you have significant excess liquidity in the business so they can redeploy that to repurchase shares and grow the dividend in the future. So we think there's lots of ways to win with M&T Bank, not just because rates are rising, but they're clearly a beneficiary of that.
All right. A couple of good ideas there in a trading day that had few. Mark, appreciate that very much.